The ability to foresee the future of market movements, pinpointing exact turning points weeks or even months in advance, has long been considered the holy grail for traders. For centuries, market participants have yearned for a method that could offer such profound clarity and precision. While many dismiss this as impossible, one legendary figure in financial history claimed to have mastered this very art. His name was William Delbert Gann, and he developed what he called the master time formula, a system designed to unlock the market's deepest secrets. This formula promises to reveal with astonishing accuracy when a trend will reverse, offering a strategic advantage unlike any other. Today, we will delve into the core principles of Gann's revolutionary approach, uncovering how time, not price, became his ultimate guide to market forecasting. Prepare to explore a methodology that, despite its profound implications, might just be shockingly simple in its underlying philosophy. William Delbert Gann's philosophy fundamentally diverged from conventional market analysis. He asserted that time, rather than price, stood as the paramount driver of all market movements and trends. Gann believed that every action in the market was governed by an invisible underlying rhythm, a universal law of vibration. This law dictated the cyclical nature of markets, suggesting that patterns and events were not random occurrences, but rather predictable manifestations of these inherent vibrations. He often stated that history repeats itself, implying that market behavior is not arbitrary but adheres to immutable cyclical laws. Understanding these cycles, therefore, was the key to unlocking the market's future direction and anticipating its critical junctures. Gann's master time formula is not a single isolated technique, but a sophisticated synthesis of several interconnected components, all revolving around the concept of time. At its heart lie the various temporal cycles he meticulously identified and utilized. These cycles span different durations, each playing a specific role in forecasting market behavior. Recognizing their interplay was crucial for constructing a comprehensive market outlook. Gann's genius lay in his ability to observe, categorize, and apply these diverse time frames to predict market turns with remarkable accuracy. Firstly, Gann identified short-term cycles which were instrumental in pinpointing immediate market reversals. These included durations such as 7, 21, and 31 days. A 7-day cycle, for instance, often indicated minor trend shifts or consolidation periods within a larger move. The 21-day cycle, roughly equivalent to 3 weeks, frequently marked more significant short-term turning points, where momentum might exhaust itself or a new, albeit brief, directional bias could emerge. The 31-day cycle, just over a month, often signaled the completion of a short-term price swing, leading to a counter-trend move or a consolidation phase. These shorter cycles provided daily and weekly guidance for active traders seeking precise entry and exit points. Moving to medium-term cycles. Gann focused on periods like 49, 60 to 65, 90, and 144 days. The 49-day cycle, representing 7 weeks, was often associated with more substantial corrections or significant trend changes, indicating a shift in market sentiment that could last for several weeks. The 60 to 65-day cycle, approximately 2 months, frequently marked important intermediate-term tops or bottoms, suggesting a period where the market had reached an exhaustion point. A 90-day cycle, or 3 months, was considered a highly significant time frame, often coinciding with major corrections or the initiation of new, powerful trends. The 144-day cycle, a powerful number in Gann's numerology, 12 squared, was a critical marker for identifying major intermediate-term reversals that could define the market's direction for several months. These medium-term cycles offered a broader perspective, allowing traders to anticipate more substantial market moves. Finally, Gann emphasized long-term cycles, which provided the grand roadmap for market campaigns spanning years or even decades. These included cycles of 1, 2, 3, 5, 7, 10, 14, 20, 30, 45, 60, 90, and 100 years. A 1-year cycle, for example, often marked annual turning points or the completion of major price patterns. The 7-year cycle, a recurring theme in many natural and economic phenomena, frequently indicated significant economic or market shifts, often leading to market crashes or booms. The 10-year cycle, a decade, was seen as a period where major trends could complete or reverse, signaling the end of one era and the beginning of another. Longer cycles like 20, 30, 45, 60, and even 100 years were used to predict monumental market shifts, such as the onset of depressions or extended bull markets, providing an almost generational foresight into market behavior. These extensive cycles offered a profound historical context, allowing for the anticipation of truly transformative market events. Beyond fixed time cycles, Gann placed immense importance on anniversary dates. This concept posits that significant past market highs and lows possess a unique vibrational energy that can influence future market behavior. He observed that the exact anniversaries of these pivotal historical dates, or periods very close to them, frequently acted as powerful turning points for the market. These dates were not merely historical footnotes, but rather active markers, capable of triggering new trends or reversing existing ones. For instance, if a major market top occurred on a specific date in 1929, Gann would pay close attention to that exact date in subsequent years, expecting it to be a critical juncture. The logic behind anniversary dates stems from Gann's belief in the cyclical nature of time and the idea that specific temporal points carry a recurring significance. He would meticulously record the dates of all-time highs and lows, major panic bottoms, and significant turning points for various assets. Then, as these anniversaries approached, he would anticipate a heightened probability of a trend change, a sharp reversal, or an acceleration of the current trend. For example, the precise anniversary of the 1929 market crash high or the 1932 market bottom could become a powerful trigger for future market movements. This method allowed him to predict specific days or weeks when major market shifts were likely to occur, providing an almost prophetic level of accuracy. Seasonal cycles also played a significant role in Gann's time-based forecasting. He recognized that certain months of the year consistently exhibited tendencies for market reversals or accelerations. These seasonal patterns were often linked to natural rhythms, agricultural cycles, or even human psychology and financial reporting periods. Gann identified specific months as being particularly critical for market turns. For instance, January was often seen as a pivotal month, marking the start of a new year with fresh capital flows and investment decisions. May, historically associated with sell in May and go away, frequently signaled a shift in market momentum or the onset of a summer slowdown. July and September were also highlighted by Gann as months prone to significant market activity and potential reversals. July, often marking the middle of the trading year, could bring about a change in the prevailing trend. September, notoriously volatile, frequently saw the culmination of summer trends and the beginning of new, powerful movements as traders returned from holidays and economic activity picked up. By combining these seasonal insights with his other temporal analyses, Gann could refine his forecasts, adding another layer of precision to his predictions. Understanding these monthly tendencies allowed him to anticipate periods of heightened volatility or potential trend changes, further enhancing his master time formula. While time was Gann's primary focus, he never entirely disregarded the importance of price. Instead, he sought to find a harmonious relationship between the two, an idea he termed the squaring of price and time. This concept is central to his entire methodology, representing a profound understanding that significant market events occur when price and time align in a specific geometrically resonant manner. It suggests that there is an underlying mathematical structure to market movements, where the vertical movement of price and the horizontal passage of time are intrinsically linked. Gann believed that true market reversals and major trends were most probable when this delicate balance was achieved, creating a point of maximum energy and potential for change. The squaring of price and time is the concept that when the price of an asset and the time elapsed from a significant turning point become equal or are in a harmonious mathematical relationship, a major market event is likely to occur. This harmony is often based on geometric principles, where the square root of a price level or a specific number of time units forms the basis for prediction. For example, if a stock reaches a price of 100, its square root is 10. Gann would then look for time periods that are multiples of 10, such as 10 days, 10 weeks, or 10 months, from the last significant turning point. When price reaches a certain level and a corresponding time period has elapsed, this squaring signals an imminent shift. In practical application, Gann would often calculate the square root of a significant price level, such as an all-time high or low. He would then look for time periods that were direct multiples or harmonious divisions of that square root. For example, if a market made a significant low at 49, its square root is 7. Gann would then anticipate important turning points at 7, 14, 21, 49, 70, or even 100-day or week intervals from that low. This method added a layer of mathematical precision to his time analysis, allowing him to identify specific points where the market's internal rhythm dictated a change. The idea was to find where the time factor met the price factor, creating a powerful confluence. To aid in this complex process of squaring price and time, Gann developed several unique tools. Among the most famous are the square of 9 in Latin, Gann angles. The square of 9 is a spiral chart where numbers are arranged in a specific geometric pattern, allowing traders to quickly identify price levels that are harmonically related to a central starting point. By finding the square root of a price and then locating it on the square of 9, Gann could identify potential support and resistance levels, as well as future time targets, based on its angular relationships. This tool provided a visual representation of the time-price relationship, making it easier to spot potential turning points. Gann angles, another cornerstone of his methodology, are diagonal lines drawn from significant highs and lows at specific angles, such as 1 by 1, 1 by 2, 2 by 1, 1 by 4, 4 by 1, etc. These angles represent a precise relationship between units of price and units of time. For example, a 1 by 1 angle means 1 unit of price moves up or down for every 1 unit of time that passes. When price action intersects or breaks these angles, it signals a change in trend or momentum. These tools were not merely indicators. They were geometric representations of the inherent order Gann believed governed market movements, helping to identify crucial levels where time and price would converge. The ultimate goal of Gann's master time formula was to predict exact market turns weeks in advance, a feat he reportedly achieved with astonishing regularity. This was accomplished by meticulously integrating all the factors discussed: the various time cycles, anniversary dates, seasonal patterns, and the critical concept of squaring price and time. Gann understood that no single factor worked in isolation. Rather, their confluence created the most powerful and reliable signals. He approached market analysis like a master conductor, orchestrating a symphony of temporal and price-based indicators to reveal the market's next move. Gann combined his time cycles with sophisticated price-level analysis. He did not just look for time targets. He also identified specific price levels where reversals were likely to occur. These included common Fibonacci retracement levels, such as 50%, but also his own unique proportions like 25%, 75%, and various 1/8 divisions of the range. For instance, a 50% correction of a prior trend, coinciding with a 90-day time cycle, would create a much stronger reversal signal than either factor alone. This layering of analysis provided powerful confirmation for his forecasts, ensuring that he wasn't just guessing based on time alone. Furthermore, Gann utilized graphical analysis, particularly his unique 3-day swing charts, to confirm his time and price signals. A 3-day swing chart simplifies price action by only plotting a new point when the market has made a high for 3 consecutive days, or a low for 3 consecutive days. This method filtered out noise and helped to clearly define the prevailing trend, and identify when it was truly reversing. If a significant time cycle indicated a potential bottom, and the 3-day swing chart then generated a buy signal, the confidence in the forecast would significantly increase. This integration of visual confirmation was vital for actionable trading decisions. The core principle driving these predictions was Gann's belief that, when time meets price, a change is inevitable. This phrase encapsulates the essence of his methodology. It signifies a moment of critical equilibrium where the forces of duration and value converge, making a shift in direction almost a certainty. When a specific time cycle, an anniversary date, or a seasonal tendency aligned with a significant price level or a squared relationship, Gann saw this as an unequivocal signal. These points of confluence were the precise moments he anticipated for market reversals, allowing him to position himself ahead of the crowd. Historical accounts and his own writings reveal numerous examples of Gann's uncanny forecasting ability. He famously published annual forecasts for major markets like cotton, wheat, and the stock market, often predicting exact dates for significant turning points months or even years in advance. For example, he accurately predicted the 1909 high in wheat, the 1929 stock market crash, and the 1932 bottom. These were not vague predictions, but often specified dates and price ranges. His ability to outline the market's future trajectory with such detail cemented his reputation as one of the greatest market forecasters of all time. Such foresight allowed him to navigate the markets with exceptional precision. Understanding and applying these cycles provides traders with an unparalleled advantage, enabling them to significantly improve the accuracy of their entry and exit points. By knowing when a market is likely to reverse, traders can avoid entering near a top or exiting near a bottom. Instead, they can anticipate these movements, positioning themselves strategically before the crowd reacts. This proactive approach to trading, moving beyond reactive analysis, transforms trading from a speculative gamble into a more calculated and informed endeavor. Gann's methods offered a roadmap, allowing traders to forecast market movements before they even began, providing a critical edge in a highly competitive environment. For those interested in delving deeper into the mind of William Delbert Gann and understanding the foundational principles that underpinned his incredible market predictions, his classic work, Truth of the Stock Tape, offers invaluable insights. This book is a timeless exploration of market cycles, the psychology of speculation, and the intrinsic relationship between time and price. While the concepts within are profoundly insightful, it is important to note for those considering its study that the original historical charts included in the book are often of very low quality, making them difficult to decipher and analyze. However, the theoretical framework and the wisdom contained within its pages far outweigh this minor inconvenience, providing a rare glimpse into the strategies of a trading legend. By studying Gann's own words, you can begin to grasp the nuances of his approach and understand how he developed his unparalleled forecasting abilities. To unlock these timeless secrets and gain a deeper appreciation for the cyclical nature of markets, consider exploring Truth of the Stock Tape. You can find a link to this essential read in the description below, allowing you to embark on your own journey into Gann's world of market mastery. The title of this video, shockingly simple, might seem paradoxical given the complexity of Gann's methods. However, the simplicity lies not in the ease of application, but in the universal nature of the underlying cyclical laws he discovered. The idea that everything in the universe, including markets, operates on predictable cycles is a profoundly simple concept. Yet, the process of accurately identifying, interpreting, and applying these cycles to specific market data requires immense dedication, deep study, and extensive practice. It is a science that demands both intellectual rigor and intuitive understanding, far beyond a superficial glance. While the core philosophy that time is the ultimate arbiter might be simple to grasp, its practical implementation is anything but. Gann himself spent decades meticulously analyzing market data, discovering these intricate relationships. The simplicity can be found in certain foundational elements that even beginners can grasp. such as the basic use of swing charts to define trend direction. Identifying higher highs and higher lows for an uptrend or lower highs and lower lows for a downtrend is a relatively straightforward concept. However, integrating this with precise time cycles and price squaring techniques elevates it to a whole new level of sophistication. Gann's success was never attributed to a simple trick or a superficial indicator. Instead, it was the culmination of his profound understanding that time, not price, is the ultimate arbiter of all market trends. Price movements are merely the manifestation of underlying temporal forces. By focusing on time, Gann was able to look beyond the immediate fluctuations and perceive the grand, cyclical patterns that dictated market behavior. This deep philosophical insight, combined with rigorous mathematical and geometrical analysis, allowed him to construct a framework for predicting market turns that remains unparalleled in its ambition and reported accuracy. The shockingly simple aspect is the elegant truth of cycles, hidden beneath layers of market noise. In conclusion, William Delbert Gann's master time formula offers a revolutionary perspective on market analysis, asserting that time is the most crucial factor governing market movements. We have explored its key components, including the various short, medium, and long-term time cycles, the significance of anniversary dates, and the influence of seasonal patterns. The profound concept of squaring price and time, where these two dimensions converge in harmony, stands as the central pillar of his methodology, allowing for the identification of precise turning points. Gann's integration of these temporal insights with price-level analysis and graphical confirmation enabled him to forecast exact market reversals weeks or even months in advance. His legacy challenges conventional wisdom, urging traders to look beyond mere price action and delve into the deeper cyclical rhythms of the market. While applying these methods demands dedicated study and practice, the potential rewards are immense. By understanding and integrating time cycles into their trading strategies, market participants can gain a significant, almost predictive advantage. Mastering time, as Gann demonstrated, offers a unique roadmap to the market's future, allowing traders to move confidently beyond assumptions and reactive decisions. Embrace the power of time, and you may just unlock a new dimension in your trading journey, transforming the way you perceive and interact with the financial markets.